there's a word that I keep hearing thrown around here by Mohammed Al-Arian, who I respect quite a lot in these matters. He talks about Fed credibility, and he thinks they have an issue with credibility. And he was thinking that a big rate hike would help restore Fed credibility. The grounds for that was something along the lines of saying, look, it shows they're serious about doing what needs to be done to tackle inflation, right? So they're not afraid to push the big hike if they really feel they have to. They've said they want inflation under control. Here's them doing what it takes to do that. Or showing willingness to do whatever it takes to do that. I kind of see this credibility thing as double-edged a little bit, to be honest. It sort of makes me think that a big rate hike is an admission that we weren't fixing this problem with small rate hikes, which gives me something of a credibility issue, because the more they keep hiking and the faster they keep hiking and the deeper, sharper, higher, whatever, they keep hiking here, the more it feels to me like they're whacking a panic button, or getting closer and closer to whacking a panic button, because as you pointed out, inflation is indicating that prices are up around 8% from where they were a year ago. It's not slowing things down. The target is supposed to be somewhere around 2, I think.
Yeah, and it's definitely not 2 at the moment. It's at 8, and I think I understand that argument. I think part of earlier on they tried the megaphone approach, didn't they, with inflation? They basically tried to tell you that there wasn't going to be any inflation. So if the Fed is a supremely credible being, then perhaps the megaphone approach of actually not doing anything and just saying everything's all right can actually make the market okay. But as the market loses credibility, as the Fed loses credibility, and the market reacts in different ways, and the inflation reacts in different ways, and I suppose he's right in that the Fed does lose credibility, and it's supposed to be an apolitical organisation. It's supposed to do what's best for the economy. So I guess best for the economy and best for the people at the moment is to get inflation down. I think that would be tricky for us to deny that. And at the moment, the only tool they seem to have, the 2 tools that they have is quantitative tightening and raising the interest rates, and they're doing both of them. So it's hard to criticise. I guess we'll see. I mean, we'll be having this conversation in another quarter's time, and we may have completely different inflation numbers. I was expecting to see it coming down, to be honest, but as investors, the investing mindset is almost definitely to have a little bit and look forward to a little bit of prolonged pain, because this prolonged pain that we have now, where there's a lot of uncertainty in the market, a lot of uncertainty over the inflation numbers, is driving some prices of some fantastic companies down to reasonable values, and it's our job to buy these companies at these prices, find them, buy them, and hold them. So we don't want it over too fast. As much as it is horrible logging in and seeing those 5 and 10% red days or whatever there was over the last couple of weeks. If you're early in your investing career, these are, like we said last week or the week before, these are gifts. And if we can string this out a lot longer, so we can get all of our, as much money as we can in the market and buy as much as we can, we should do really, really well in the long run.
Yeah, you're right. I mean, here's how I'm sort of thinking about things. I receive dividends every so often, not at the rate that Paul does particularly. I'm not as enthusiastic about dividends as he is, but realistically, I'm going to get dividends at a certain time, at a certain level, and I'm going to reinvest those dividends. And the question is, for me, I think, do I want the price to be high when I reinvest them, or do I want the price to be low when I reinvest them? I'm not planning on selling anything anytime soon, particularly unless I get a glaring, obvious opportunity to move some money around. But I'm going to get some money. It's going to come either in form of a dividend or as a deposit or something like that. And if I'm going to deposit 200 quid and I'm going to buy Meta Platforms shares, do I want 1 share for that or a share and a half for that? And that's pretty much all it comes down to from what I can see of things here. You're right, though. As kind of longish term looking investors, this sort of thing is nice, but in the course of, and it feels significant at the moment, but in the course of an investing career, we're going to see a lot of quarters, and we're going to see a lot of interest rates going in different directions, and sometimes they'll go up and sometimes they'll go down. And at the moment, it feels like a particularly difficult time. There is an awful lot of macroeconomic headwind coming through for now, but it's important, I guess, for us to try and keep our eyes on businesses and distinguish between things that are pushing down share prices and things that are making companies' lives more difficult, because there is absolutely both. Inflation is making life harder for certain companies. They have to pay more for the stuff that they make their products out of if they're that kind of business. They have to try and push those prices through to customers who are already getting squeezed everywhere else by rising costs of everything. And it may well be that hits company profitability, which is the kind of thing that we absolutely should care about. And I was hearing on a different podcast that once all this kind of Fed, QT, interest rate hiking, so on and so forth happens, there's a sort of 6 to 24 month lag, which is quite a big window to fire into. But the next kind of leg down for the market, they were talking bearishly about it, is to do with earnings dropping off, basically, as a result of these sorts of things, as these things kind of take effect. There's the initial reaction and the shock in shock prices, and then the earnings come in, and then they're not as good as you thought they were, and everything gets downgraded, and all of a sudden a PE of 18 is a lot lower than it was before, basically.
Yeah, just to add to that, obviously inflation affects the companies who are dealing with raw materials and things like that, and going on from there. But interest rates affect the opposite side. It's the consumer this time who get a better savings rate and a worse borrowing rate. So it's double-edged pressure there. If you was getting 3, 4, 5% on your savings account and you had a loan of 10, 11, 12%, the likelihood is you're going to be saving and paying off the loan rather than buying consumer discretionary things. So, yeah, definitely, it's worth, when you're looking at these PEs and you're looking at forward PEs, which we do quite often, just to remind yourself that they probably will be getting downgraded over the course of the next quarter, at least when we just see exactly what's happening with the sort of UK, US and beyond that economies.